different like there. Monetary policy. What is monetary policy? Monetary policy refers to the management of the money supply. Basically, we are going to control the market supply of the money by the State Bank of Pakistan or any reserve bank. While we are controlling all these things, that is known as monetary policy. Monetary policy refers to the management of the money supply. The theories guiding the Federal Reserve, Federal Reserve means State Bank of America, are complex and often controversial. We are affected by this policy, and a basic understanding of how it works, therefore, important. And what we will study in this chapter are, number one, how federal means central bank. Action affects reserves in the banking system, the market for reserves and the federal fund rate, conventional monetary policy tools, non-conventional monetary tools, and quantitative easing, monetary policy tools of the ECB, European Central Bank, the price stability goals and the nominal anchor. Other goals of monetary policy: should price stability be the prime goal of the monetary policy? Inflation targeting. Should central banks respond to asset price bubbles? Lessons from the global financial crisis. Now, how federal actions affect reserves in the banking system? How central bank take action and how they will manage and change the reserves in the banking system. All banks have an account with the central bank, but in which they hold deposit. We have already discussed that it is mandatory for all the commercial banks to keep a percentage of their total funds which are received by the account holders to keep a certain percentage of that reserves with the central bank. That is known as a required reserve, which is mandatory for every bank to keep with the central bank. Any reserve which is in excess of required reserve, means mandatory reserve, will be known as excess reserve. Reserves consist of deposit at the federal plus current, that is physically held by the bank, and all the reserves held by the bank itself, which are not given to federal bank, they are all accommodated in as excess reserves. So excess reserve may be held with the bank itself or with the central bank. The federal sets the required reserve ratio. What is the ratio that the commercial banks are required to keep with the central bank? These are decided by the central bank. The portion of deposits banks must hold in cash. Any reserve deposited with the Fed beyond this one are excess reserve. The Fed injects reserves into banking system in two ways. And how the central bank injects that reserves which are kept with them in the banking system. They have two options. Number one, open market operations. Number two, loans to banks, referred to as discount loans. Either they will inject that reserves by open market operations or directly give loans to the commercial banks at discounted rates, and that's why they are known as discount loans. In the next two slides, we will examine the impact of open market operations conducted through primary dealers. As suggested in the last, I will show the following. Purchase of bonds increase the money supply. Whenever State Bank is going to purchase securities from open market, it means the money supply in the open market automatically increase. Making discount loans increases the money supply. or when they are making loans to their own commercial banks, the money supply with the commercial bank increases. Naturally, the Fed can increase the money supply by reversing these transactions, and vice versa. If they want to decrease the money supply, they will do the reverse action. Same with your foreign currencies. Just like you see the dollar price. If dollar price goes to 168 and government wants that these dollar price should come down, the government sells the reserves of dollar with the government, means state bank. They will sell them in open market. When the supply increases in the open market of dollars, the dollar price goes down. Vice versa, if government wants that the dollar price should go up, they will start purchasing dollars from the open market. And when the demand increases in the market, the dollar prices goes up. That's how government somehow control the prices of the dollars or any other currency. Same with the money supply. When they want to increase the money supply in the market, they purchase securities from the market. Securities come to state bank and the cash goes to the market. And when they want to decrease the money supply in the market, they keep on selling the securities. So when people buy and banks and all marketplace buy the securities, the cash flows from buyers to state bank. And that's why how the money supply in the market will go down. This is the balance sheet of one banking system. They have the reserves of 100 and loans of 100. On federal, means state bank, they have discount loans of 100 million and reserves of 100 million. We will now examine how this change in reserves affects the federal funds rate. They will show that how government can change the rates in the market by offering excess money. With excess supply of reserves, the federal funds rate falls to I. Okay. With excess supply of reserves, the federal funds rate falls to IFF, means from this to this level. With excess demand for reserves, the federal funds rate rise to I. This is the level, and when the excess demand increases, they will go upward. How operating procedures limit fluctuations in federal funds rate? Changes in the demand for reserves will not affect the Fed funds rate. Borrowed reserves will increase to match the demand. This is true whether the demand increases or decreased. Conventional monetary policy tools. We further examine each of the tools in turn to see how the Fed uses them in practice and how useful they are. Tools to monetary policy. How state bank and what are the tools with the state bank to control the market? They have two tools of monetary policy. For monetary policy, they have two options. Number one, open market operations. which are more dynamic, change reserves and monetary base, and defensive, offset factors affecting reserves, typically uses a repos. Advantages of open market operations. Fed has complete control. What advantages they have when they go to open market operations to control the monetary policy? They have complete control. Whatever they want to do, they can do there. Flexible and precise. It is very flexible. They can inject the money in the market. They can take out their funds from the market, and very precise. There is no long procedures involved in that. Easily reversed. And if at any time State Bank takes any action and they saw and foresee that there is a adverse effect on the economy or the market, and this is against what they want to do, they can easily reverse it. That's why it's more convenient for the state banks to use open market operations. Implement it quickly. And again, they need not so much fireworks and relativism and approvals from the different government departments to implement it. It is rapid, and they can do it immediately without any formal formalities. Inside, day at the trading desks. The staff reviews the activities of the prior day and issue forecast of factors affecting the supply and demand for reserves. What their team is doing, the team of the State Bank, this review the activities of the previous day and what effects their actions in the previous day have on the market, and issue forecast of the factors affecting the supply and demand for reserves. And they also give the forecast what will happen if their supply and demand is controlled. This information is used to determine reserves changes needed to obtain a desired federal funds rate. That's why how when they have the information of their past day and prediction of future, now they can decide should the supply of money be increased in the market or reduced to control the interest rate. Government securities dealers are contacted to better determine the condition of the market. Even in open market, everyone is not dealing with the government securities. There are some dealers who are dealing in the government securities, and government means State Bank are in touch with those players of market to foresee the market and to control it and get the feedback from them. Projections are compared with the Monetary Affairs Division of the Board of Governors, and the course of action is determined. All these information and projections and results of the previous are shared with Monetary Affairs Division of the bank. Once the plan is approved, the desk carries out the required trades by the trap system. And when they decide about the course of action, they will go to the market and implement it through traps. A trading desk typically use two types of transactions to implement their strategies. And how they will implement their strategies: number one, repurchase agreements. The Fed purchases securities from the market but agrees to sell them back within about 15 days, so the desired effect is reversed when the Federal sells the securities back. Good for taking defensive strategies that will reverse. So if they want to increase the rate or decrease the rate, they can buy and sell the securities in the market. And to control the impact of that sale or purchase, they can enter into buyback agreement with the market players. Say they give a period of 2 weeks that we are purchasing these securities. By purchasing securities, the demand for those securities will go up, and they give understanding to the market players that they will sell them back within 2 weeks in the open market. To again, prices will come down when they will sell. Match sale purchase transaction, essentially a reverse repo where the federal sells securities but agrees to buy them back. The federal discount loans through the discount window are. And what are the discount loans? The loans directly given to commercial banks through their discount window. Primary credit, what is its impact is healthy banks borrow as they wish from the primary credit facility or standing lending facility. Those banks whose business is growing at a good pace and they need more fund to lend their customers, they are the primary user of that offer. That's why they are known as primary credit, because they need funds, and when State Bank offered, they are very much there to buy them. Then secondary credit given to troubled banks, and second stage is means secondary use of these offered discount loans is that those banks which are in a liquidity problem, they needs funds. They will get the funds from the State Bank at that discounted rates to meet their liquidity demands. Seasonal credit designed for small regional banks that have seasonal patterns of deposits. Some demands in the market by the commercial banks are seasonal, just like in December and January, when this sugar crushing season, the sugar mills need more funds to buy the raw material, because as you know, these sugar mills will work only for 2 or 3 months in a year when there is a crop of sugar cane, and at that time they need huge amounts to buy the raw material and to stock the sugar, prepared sugar. They approach their banks, and this is just known as seasonal credit banks need to extend to their customers. Likewise, in I think so around August, September, the cotton users, ginning factories, they need funds, and these are all known as seasonal credits. Lender of last resort function. As we already discussed, that State Bank is the lender of last resort. When any commercial bank is in trouble and needs funds, they will approach State Bank, and the only hope for them is the State Bank. Then State Bank will provide them with the required funds. Really needed. What about the okay? As a lender of last resort, they help to avoid panics. Just like when there is a rumor that some bank is going short of funds and they can't meet their liabilities, it's natural. People will, especially the account holders, they will approach the banks and immediately want to withdraw their funds. At that time, even if the bank is in a position, but still there is a huge demand for cash outflow. At that time, just to avoid that panic and keep the confidence of the customers, commercial bank needs immediate cash. At that time, State Bank come to their rescue and give them extra funds so that they can meet the demands of their customer, and that panic that the bank is going to be liquidated or banks insolvent will go off. But there are costs. All these things fetch a cost. Banks and other financial institutions may take on more risk. When you increase the loans to the banks, the more risk will increase. Moral hazard that the banks have more sufficient fund and then they can go for some risky investments. That is known as a moral hazard. Reserves requirements. Reserve requirements are the requirements put on financial institution to hold liquid cash against checkable deposits. First, we just see that I tried to you see this the recording now. We make it in this folder and it's still empty. There is no file. Financial institutions to hold liquid cash again checkable against checkable deposits. What are the reserve requirement policy and how State Bank use it as a tool of monetary policy? They can change the percentage of mandatory requirement with this State Bank. Usually they don't change it more often, just to avoid he say rarely used as a tool. Raising causes liquidity problem because if they raise the mandatory requirement, bank may go into a liquidity problem. And if they makes a liquidity manual unnecessarily difficult, and it will be more difficult for them to manage it for banks. If State Bank is frequently changing the mandatory cash requirement with the bank, the global financial crisis challenged the Fed's ability to stabilize the economy. Financial system seized zero lower bound problem could take rates below zero. The problem called for the use of non-conventional tools. That is exclusively with the American economy. When they have a financial crisis, their financial system seized. Discount windows expansion, discount rate lowered several times, and what actions they take in their country by the Fed system that they reduce their discount rate several times to overcome that problem.
रिस्पॉन्स मिला ना अल्लाह तुझे और तरक्की देगा मेहनत कर बस
Now they have quantitative easing versus credit easing. What they have to do and how they will control. Quantitative easing programs dramatically increases the Fed's balance sheet. Power force to stimulate the economy, but perhaps also lead to inflation. Although they can control it but while using this tool, the inflation rise dramatically. Quantity is, however, short-term rate is already near zero. Not clear further actions helps. Banks are not lending. Money supply did not expand. And in that, when they use quantitative easing, banks are not lending because they are short of funds and money supply did not expand. That's why the money supply in the market will not expand. And what the chairman of Fed, Ben Bernanke, argues that the Fed has been engaged in credit easing. Instead of quantitative easing, they should go for credit easing actions to impact credit markets. How does this work? He says, and he's of the argument that we should go to control the credit market. Liquidity can help unfreeze markets that have seized. When the markets are seized to a certain level, liquidity problem can increase it, and especially when we go to lower the interest rates, many businesses which are reluctant to take loans at the higher interest rates, now they will feel it more comfortable to take the loan and again try to run the business or meet their liquidity needs. Asset purchases can lower rates on those assets, focusing on specific markets. Just like if State Bank want to support the real estate market, they can specially give loans by commercial banks to the users to buy the real estate at the lower interest rates. By committing to maintain short-term rates near zero, future short-term rates should also be zero, meaning long-term rates fall. If you are already come to near to zero, you can't go beyond that. It means you will be stand their economy for the long period of time. This is known as forward guidance. Fed started this policy in a longer commitment to low Fed rates is conditional, predicated on weak economy. Could take an unconditional commitment to keep rates low regardless of the economy. What is conditional? That they are keeping the interest rate low because of weak economy. And what is unconditional? That State Bank will give that we will keep these rates at lower side even if the economy is recovering. However, unconditional commitments can be tough, especially if circumstances change become a credibility problem. Negative interest rates on banks' deposit. Central banks in Europe and Japan have started experimenting with charging banks negative interest rates on deposits held at the State Bank, supposed to encourage banks to lend as opposed to holding deposit. When commercial banks hold their reserves with the State Bank give them a lower interest rate. In Europe, they try another thing by making zero interest rate or negative interest rate, so that the commercial banks are discouraged to keep their funds, excess funds, with the State Bank. So they have more cash with them to lend more to the customers. That's how the money will be injected in the economy. Banks could just hold cash instead of depositing money with the central bank, but the cost of that. Another method is that the banks will hold cash with them instead of depositing it in excess reserve with the State Bank of Pakistan. They will keep that excess reserve with them as a liquid asset. But for that, they need vaults, guards, and security system, all these things, and that will cost a high, that will attract a high cost. Lower profitability might lead to banks to lend less. And if the market profitability is low, then banks will refrain from giving loan to the market. Results not clear. The Fed announced that it would not use negative interest rates as a tool. As the outcome and the results of this tool is not clear cut, that's why the federal system of USA, they will announce that it would not use negative interest rate as a tool. For the European Central Bank. Now they have we have discussed the federal system of America. Now they are going to discuss the European bank system, European Central Bank. So we have already gone through. Yes.
सर आज जल्दी छुट्टी मिल सकती है?
We have only 10 minutes left, and let me finish this. What are the goals of the monetary policy other than the control of inflation and interest rates and market supply of the cash? Their goal is high employment. They want to create employment by using a monetary policy. Monetary demand, supply, or natural rate of unemployment, economic growth, stability of the financial markets, interest rate stability, and foreign exchange market stability. These goals are often in conflict. While you are trying to increase one goal, it will cost you at the end of another goal. Just like price stability is not consistent with the other goals in the long run. However, there are short-term trade-offs. An increase in interest rate to help prevent inflation, but increase unemployment in the short run. Inflation targeting. What is the another target of the monetary policy is to control the inflation. Inflation targeting involves announcing a medium-term inflation target. You have to give a medium-term inflation target that how you will control them. Commitment to monetary policy to achieve the target. Inclusion of many variables to make monetary policy decisions, increasing transparency through public communication of the objectives, and increasing accountability for missed targets. Inflation targeting, what are the advantages and disadvantages? Advantages are easily understood by the public. If you give them a clear-cut policy that we are going to do this by using these tools, and we will try to keep inflation just like 11 to 9, people can easily understand that. Helps avoid the time inconsistency problem, since public can central bank accountable to a clear goal. And while you are giving your targets, you are also giving a time frame for that we will achieve this target in 2 months, 3 months, 6 months, or a year. Forces policymakers to communicate goals and discuss progress regularly. And in that case, you have to timely inform the public and the public at large and all the stakeholders about the outcomes of your policies. and the changes you are going to make in your policies. Performance has been good. Also, when you are accountable to the public, your performance will automatically increases. What are the disadvantages? Signal of progress is delayed. Effects of policy may not be realized for several quarters, because one thing we know that economy is a dynamic and non-controllable by very few factors and a few actions, and they will take their own course of action. It means when you are implementing a policy, its outcomes or results may come in more than a quarter, 2 quarter, 3 quarter, or it will take a few months. Policy tends to promote too much rigidity, limits policymaker ability to react to unforeseen events. Even when you are give the policy and your targets, there are, just like we said, the economy is dynamic and uncontrollable. So there are very much unforeseen events. You can't predict at the time of making the policy, just like this COVID-19 pandemic. Nobody was predicting that. So in that case, you have very rigid policies, and you can't accommodate these things. And you have just like in Pakistan, we have to change all our targets after this COVID, because it is just an unseen event. Usually, flexible targeting is implemented, focusing on several key variables and get modified as needed. That's why they use flexible targeting, so that they can change the targets, its variables and limitations. What are the disadvantages? Potential for increasing output fluctuations may lead to a tight policy to check inflation at the expense of output, although policymakers usually pay attention to output. When you have a very rigid policy and you have a target to achieve, then you go with your policy very rigidly. In that case, maybe inflation goes out of control, or while you are very much controlling and try to control the inflation, your output will affect, usually accompanied by low economic growth, and may lead to low economic growth because of tight policy and to control the inflation. Probably true when getting inflation under control. However, economy rebounds. He said when you are trying to control the inflation, your economy growth level will slow down or maybe come to a standstill. But it's not for a long time. It will rebound after that, but it will take time. Okay, we will complete this chapter in our next, and I think yes, there are still two topics are there, asset pricing. So we are left with only asset price bubbles. If you guys can go through it at your own, we will try to start next topic in next lecture. ओके आप लोग इसको जरा गो थ्रू कर लें ताकि ये चैप्टर कंप्लीट हो जाए. कुछ स्लाइड्स रह गई हैं इसकी, आप खुद इसको देख लें, और अगर कोई क्वेश्चन होगा तो नेक्स्ट में हम करके ताकि नेक्स्ट में हम नेक्स्ट टॉपिक स्टार्ट कर सके. हम 2 लेक्चर्स पहले शॉर्ट हो गए. दो लेक्चर्स का फर्क है, हमें थोड़ा सा इसको तेज चलाना पड़ेगा। तो ये स्लाइड्स आप खुद देख लीजिएगा और इस जो क्वेश्चंस होंगे वो करके, ताकि हम अगला चैप्टर फिर नेक्स्ट लेक्चर में स्टार्ट करें।